Thank you. So without any further ado, I'd like to invite the Prime Minister to give a speech, not exceeding 7 minutes. Here.
Thank you. I think that at the moment in which you have 1 billion assets as a company, there is no valuable reason for you not to go publicly traded unless you wish to hide the information that is very valuable for both customers and the shareholders. We think that at the moment in which these guys don't go publicly traded, in which they're unicorn companies, they're able to do certain things that other business models don't allow, which gives them a better position at the market and more money at the end of the day. We wish to stop this terrible practice by making them go public. So what are the companies able to do if they don't go public? If they don't publicize their shares. Firstly, they're not necessarily obliged to share information about their assets, their funds, or their revenue. Secondly, they have more autonomy in what they're doing, how they operate their business models, how their business models function, what their business models are, and how practical they are, and how useful and how great they work. And thirdly, they're not necessarily overseen by committees or national, governmental bodies that oversee actions of the markets and business models of various companies. Why is this important? Because this means that the information you get about how well a company works is not necessarily true information. It's usually screwed information that the investors get. This is usually because these companies don't go to the stock market exactly because of the fact they want to give you false information so they can attract more investors by positioning themselves as a great company that actually has a valuable and a great business model. Secondly, because CEOs usually are able to make investors feel like they're good, not to necessarily look into their papers too much, to make them believe that their business models are great and working. Why is this important? Because this means that these companies, that people have a feeling that these companies are doing much better than they actually are in reality, that they earn much more money, that their business models are great, and that they're pro futuro able to work at the same rate. Right? Why is this important? Because this means that you don't have, as a buyer, as a share owner, or generally as a market, you have no scrutiny over what they're doing, right? Over their business model, over their activity, and everything else. The impression that you have that they're really good and they're like doing great is something that makes them look better, but at the end of the day, they have terrible business models usually, and are usually not sustainable as companies. This also means that there are the other companies that are their competitors on the market that are publicly traded, that do sell their shares on the market, usually have people have an impression that they're much worse and that they're doing worse than these companies, while in reality they are not. This is because the information of how good these companies are doing do not exist or are false. This means that people are not aware that these companies are not as good and their competitors are usually better. Why is this important? Because this means that you have a worse allocation of the resources on the market. This means that these companies get more money in general by the state, and there is no scrutiny over the fact that their business model is generally unsustainable on the long run and everything else. On a comparative, we think that this means that these companies have, once they go public, they have an incentive to have a better business model because the information is now finally public and you actually know how good or how bad in most cases their business models are, which means that they're not able to screw this information around anymore, and they're not able to that you have more accountability as a state on how well they're doing and everything else, meaning that you have a moment of pressure on them to make better business models, or if they're not able to just die out or whatever. We think this is very important because a lot of these business models are unsustainable and usually fail after some time. We also think that this makes a difference at how much money you give to these companies as a state, in terms of bailouts and everything else. We think that in a status quo, when you don't have a true information about these things, you're usually much more likely to give more money to them, which makes for a worse allocation of resources that could otherwise go to other companies that actually are doing much better only because they're publicly traded and have this information up and everything else. We think this also gives for the element of scrutiny for the public regulators, right? which means that these companies are less able to do things that they're doing in the status quo, such as, for example, shady business practices that happen all the time, only because of the fact that once they're not publicly traded, nobody has any incentive or the ability to look into the way they're working, the way they're making their deals, except for like their owners and everything else. But except for them, nobody knows what they're doing and everything else. We think this makes for a much more like open situation in which you can actually see what these guys are doing and incentivize them to stop their shady business practices and everything else. You stop them from making like beautiful reports about their assets and everything else, and you have some control over how these companies function, how they work. I think this is very important, because at the moment in which you don't, at the very status quo, you're allowed these companies to give you false information and to ask for more money, and to make other competitors, to give other competitors a worse position on the market. Yes, go ahead, CEO.
So how much of the company's worth should now be public?
Like, I think that depends on the very company and the very like situation. I think like still some of the shares should be like in their owners' hands. So like, let's say 51-49 or something like that. But I think that depends, and companies should still like have a say in how much they are going to give, but would still make them like give a lot, so we can like control them and everything else. So we have some sort of control over them. I don't think there's like a direct answer to that question, which is, I mean, be exactly the same for every single situation, right? So at the end of the day, we think that the practice that exists in the status quo, in which companies are able to give you different information, gives for a worse situation on the market, makes competitors look worse, and generally wastes a lot of states' money when it comes to bailouts and how much money they give to these companies. We think this makes for a better situation on the market. We think that this stops the shady business practice, shady deals, and much better and viable business models that are able to function for a long on a long run, which is different than the status quo, in which they can do whatever the hell they want and just ask for more money, which is quite literally the reason they never choose to go public, so they don't have to share this information. I think these reasons are enough for you to vote for the opening government. Thanks, guys.
Great. I thank that speaker and call upon the leader of opposition. Here.
OG seem to think that the only reason someone would like to keep hold of a company is because they are like mischievous people who want to hide all the information away from the public. We think this is not true. We think people invest a lot of their time, a lot of their money, a lot of their emotional and cognitive abilities into the company, and they want to have control over it because this is something that is important to them, and they feel that this is something that they own. We're going to talk about why it is not legitimate to steal the companies from these people. Then we're going to talk about the stability and why sometimes it is a better choice to keep the company within the hands of the founders. But first of all, some rebuttals. So first of all, we're kind of confused about how much exactly they think they're changing within this debate. If they think that they only want to have more transparency, we don't know why this can't be solved with more regulation, right? You can force these companies to give out all the data publicly that they think is hidden away from the public. But if what they want is to actually achieve the change the behavior of the company in some way, that means that they also need to give a large amount of the shares so that actually the shareholders have control over the company and have the ability to affect it, in which case you're actually stealing away the ability of the original founders to control the company and to do what they will with it, right? Now, we do have two additional answers to this idea about transparency specifically, which seems to be the main issue. So apart from the fact that we don't know why regulation can't be enough, we think that transparency is not important to the shareholders because there are no shareholders. And when you're talking about other institutions that are going to lend you money, right? Because these companies that don't have shares, they're going to take the money from the banks or from venture capital. The banks and the venture capital are going to demand that they do give them the data, because no sane bank and no sane venture capital fund is going to give money to someone without having seen their financial records first, right? So the idea that, oh, people are just going to give them a bunch of money without knowing that it's safe. No, because people are rational, and why would they give you money without knowing that it's safe? That is not a thing on the market. Let's talk about legitimacy, right? We think that the thing is that the person who created this company, or sometimes it's a group of people, So they invest a lot in the company, right? In the terms of pouring their whole heart into the company and making this fulfill their visions and the things that they thought about. They invest a lot of their time in the company. They give up on their leisure times. They give up on sleeping. They give up on being with their families and with their friends, so they can make sure that this company succeeds and this company has the best chance in doing what it's meant to do. They take financial risks because at the beginning of the company, right, you might have to quit your other job and invest all your time in this company. You don't know what's going to come out of it. Often you're going to make financial investments in this company when it's in its early stages and you don't have the ability yet to have it work. You might go without a salary for a while because you know that you want the company to succeed, so you're also taking a large financial burden on yourself. Right? And we think that means that they have the right to ownership over these things that they've created. Like a person that creates a piece of art has ownership over that piece of art, or someone who creates a smaller business can decide what happens with that business, and artists can decide what happens with the art. We think that regulation of companies is all right, right? We think that the reason is that the regulations give you boundaries, but they don't give away your control of deciding what happens within those boundaries, of deciding the fate of your company, of just having the ownership over the company and the ability to lead it forward. We think that what they want to do is to steal these people's property, to say you can no longer have control, you can no longer decide what happens with this thing that you invested so much in, that you created. And we think that that can never be justified, and they've given us no reason to think that it can. Before we continue to talk about stability, second house, CGS.
Is it legitimate to sometimes take away someone's money from income in the form of taxes when that is better for society?
Right, so what is the relevant difference between taxes? We've just said that. We think that taxes, regulation, these things, they don't take away your ability to decide what happens with the thing that you created, right? Like I can take, you know, if I publish a piece of art, you can take taxes from the piece of art, but you can't tell me you must give this piece of art to this person, you must put it in this museum, you must send it to that country or something like that. I can decide what happens with the things that I've created. I should maintain the control over the things that I've created. But yeah, you can regulate, you can put taxes, things like that, we think are legitimate. They're not very big harm to your right to work. But we think that also often these companies are not just going to be lying mischievous companies. They feel that they can make better decisions than the shareholders are going to be able to make. And there are several reasons for this, right? First of all, shareholders are going to be very risk averse. They want to have a lot of dividends and they want to have a lot of profits. Notice that the company became public at the point where it reached the $1 billion mark. What does this mean? This means that the shareholders who are buying into it buy it as the safe part of their portfolio. The big company which is going to be reliable, which is not going to be a lot of risk. This means that they don't view it as the part of your portfolio where you're supposed to take wild risks and then have a very high return with a very small chance. They say it is the part where you don't take any risks, make sure everything stays as it is, and you don't change anything and just make it grow slowly and fine, right? But the thing is that this is often not enough because you need a lot of shifts in the market. We can see that big companies like General Motors, right, and even IBM for a while, though it is a bit regrowing now, weren't able to make the shifts that were required for the market. We think the shareholders are unlikely to be able to make this shift, and often the founders of the company are, right, because they were with the company since it started. They have in their experience the idea of having to take many risks, of having to take many shifts in the way that the company functions, having to change and be flexible all the time. And these things, and we think that as a result, are much more likely to be able to make the changes that are necessary in order to make the company keep growing, right? We also think that the founders often know that if they are, you know, I'm like 1, 2, maybe 3 founders which own the company, they have the ability to actually lead the company to the places where it needs to go, because it's a very small group of people that have a lot of experience working together that are making the decisions, right? We think that if you're a shareholder, you might understand what the reform is that must be done, but you think, A, that it's going to be very hard to convince the other shareholders, and B, that you might start rolling out your reform, and then some of the shareholders are going to get cold feet and want to undo that reform which you've started doing, because again they think this is the safe part and they're feeling like you're taking too much risk and risking the safer part of the portfolio, right? We think that that means that you don't want to start making the changes from the beginning because you're afraid as a shareholder you'll start making the changes that you can't follow through on them, which is the worst, because the company that's bouncing around is the worst thing that a shareholder can do to the company. Like we think the founders, on the other hand, because they're a small group, have much more control over the company and the ability to actually lead it to the correct places and the places that it needs to go, right? So to sum up, we said, first of all, we don't think it's legitimate and we don't think governments can prove it that it's legitimate, but we also think that these companies often have legitimate reasons to want to keep the ownership of the company. The companies are actually likely to do better within the ownership. For these reasons, please oppose.
Great. I thank that speaker and call upon the Deputy Prime Minister. Here.
2, 1. Let's see how do they respond to your case. First of all, they say, look, but what kind, like, how much actually of these companies is going to be like publicly traded? That's something that CEO also brought up. I do think that Djoedje answered that sufficiently by saying that, look, it's very often going to depend from company to company, but we do believe that it's still going to be a significant amount so that we can say that there is a lot of public scrutiny, right? Second thing that I point out is, look, but why can we solve transparency in other ways, right? Why can't we just like get them to show their books, right? This is a very tough issue and it cannot be solved by more regulation. Why? Because very often the exact reason why you want to allow private companies to exist is exactly because you want to give them certain level of autonomy and certain level of privateness and of a secretiveness about like their public motor so they can develop. And we do believe that this is something which is important for them, but it has reached its upper limit in the moment in which they are like worth $1 billion. So we do believe that if they want a more transparency, they're very often going to risk. There are a lot of companies being funded and like publicly privately owned, even though this can be very good, right? But we do believe that at the moment there's like 1 billion worth. This is not something which is very nice. Know that even in the status quo, there is certain of like amount of accountability for them to keep their books in order, right? But very often they get no legal implication in the moment when they're not reporting on how are they keeping their books, right? And very often, even when they report it very late, there is no sanction for them, right? And very often there is no public incentive to actually hold them accountable, right? The second thing that I point out about like transparency is not important because like people who are investing have the info, right? I just want to contest how true this is, right? Very often the reason why you as a like big unicorn startup can get money is exactly because you have a charismatic CEO who can go and actually get like venture capitalists who are just like seeking another investment and very often do not go very thoughtfully through your books. Very often you do get money in this way, right? But we know this very often also determines the value of other companies who are in the similar branch and who are publicly traded, right? Because if your company has a huge evaluation, right, which means that you probably are doing something right, but the public does not know that, right? The public has no info about whether your financial model is something which is sustainable, which means that exactly of that, shareholders of other similar companies are not going to invest to them in that regard, right? And that's when all of the bad stuff that Djoedje talked about like the bad allocation of resources comes about, right? WeWork was a company which was like a tech startup and they basically sold some like real estate. They got huge amount of valuation because they're a privately owned company, right? Even though companies in their own branch who were like publicly traded had much lower evaluation, right? No one saw that the business model that WeWork had was unsustainable, right? And even when they actually failed, the investors were the one who got screwed, right? Let's see their case. First point they say is, but like, look, it is unfair to take this from the people who have founded the company. Look, they are getting a cash out, right? If you have a certain like amount of money that you have in a company when you sell it, right? This is the money that you also get. They very often can buy shares of that company, right? But we know that very often in the moment in which your company has 1 billion evaluation, that probably means that you are able to get a lot of seed money. Seed money very often means that you have already gave up some of the control of your company, right? And this is not a small amount of control, as they want to point out. Very often venture capitalists can push a CEO and a founder from company when they see that he's doing something, or she, they're doing something which is like very, very bad, right? We do believe that people who are like owning the company have already kind of harmed their control over it, and we're not like nationalizing these companies, right? These people are still going to get the cash, they're still going to get the money, and if the like shareholders find them very valuable for the company, they're probably going to keep them right there. I don't see why this is such a big harm for them. Second thing that I point out is, look, but like shareholders are like risk averse and they're going to make bad choices, right? Look, Amazon is a publicly traded company, right? It has not paid dividends once. Why? Because it is able to actually say to the shareholders on the shareholder calls, which are like very often, like it can say to them, look, we are investing all of this money back into our company. We're not going to pay you dividends back because exactly this is the money that we need to invest, right? Very often people who are owning the shares of huge company are there for the long term, right? And they can understand that this is something which can be good for the company in the long run, right? Certain decisions or like certain changes, right? I don't think this is something which is that big of an issue. On a comparative, companies are pushed to create more sustainable business models and not rely on secrecy and not rely basically on their charismatic CEOs actually like getting the money, etc. CEO point. Yep.
Yeah, it's not about incentives. It's about that the tax rate for you to extract money from the company via dividends is much lower than for you to extract if you're the owner of the company. So that's where the discrepancy comes from.
Yeah, but I don't see how that in a significant way harms the business model of the company, right? We do believe that accountability, which is going to be significantly higher, is actually going to be very, very important, right? Because as Djoedje pointed out, business model of private companies can be very faulty, and very often investors can invest and very often do not notice this, right? This is what happened with the WeWork, right? Like the WeWork company got a huge amount of money from SoftBank, right? The company failed in the end. No one saw this exactly because there was not that amount of public pressure on the company to actually report their earnings and to actually report what they are doing. Even people who should be taken more of a more cautious stance, right? Because they are the investors. Very often, even they get affected by this. The ultimate effect of this is that we get huge ineffective allocation of resources, right? Because investors who invest in these companies very often get screwed, and B, very often there is no investment in other companies in similar branches who are publicly traded and which value we do actually know, right? And I do think that important frame to notice here is in a moment in which you're $1 billion company and you have not go out to the public to be publicly traded, even though this is a way for you to get huge amounts of money and investment, right? It probably means that there is something in your business model that you know that the public shareholders will notice and hold you accountable, right? This is something which is very, very important. Very proud to propose.
Okay, great. I thank that speaker and call upon the Deputy Leader of Opposition. Here.
Gonna start in 3, 2, 1. Look, I'm going to just talk about 3 things in this debate. I'm going to show you why they're the most important, and we're going to win just based on that. We're going to talk about transparency, where you get it, and why, and is this necessary. 2, we're going to talk about the legitimacy, and 3, we're going to talk about the stagnation, and just in each one of them, I'm going to show you why. The second half is going to have to do a lot to weigh against those in order to win this debate. Let's deal, first of all, with this whole thing of transparency, right? Because we just get very little, the entire case coming out of Gov seems to be dependent on the fact that this is the only way to ensure that you get this information out there. We don't understand, and there's not enough explanation as to why this is true. What they said is, well, one of the reasons that you want to keep companies private is so that they keep this private information. Sometimes it's necessary for them. And we're like, okay, so let's look at the balance. Either you both tell them they have to provide this information, which is harming them to some extent, and they have to give up a significant number of shares and sell them off and make changes to the way the company is structured, or you only do the first one. We accept this might harm some of their ability to do some things, and that's obviously not always great, but given all of the benefits that Prop tell us about why transparency is important, we're just going to do that and still force them to do that. We also think that there's a lot of regulation and scrutiny on them. We're talking about a very small number of companies that are this massive in the world, right? We think that these companies have a lot of scrutiny on them from the IRA. There's a lot of people who've invested money in them and who, when they do things and are unaccountable for them, have a lot of money with which to sue them for things like fraud or for unlawful competition and all kinds of laws that exist and regulate, and there's incentive that rich people have for these things to exist and for them to regulate. We don't understand why these don't exist and why they're not enough and why they're not going to be scrutinized and how they can just defraud people. We also think when it comes to looking at competitors, the same is true. The second we force them to put out this information, they will no longer be able to magically steal from their competitors in ways that we don't understand how exactly they work and why people who actually have the money to care about these competitors don't have a good enough ability to look into each of them. But also we tell you, their own model, why is that true only from when they're $1 billion company? If when they're $1 million company, are they not also unfairly competitive in the market or something like that? What difference does it make? I genuinely have no idea, right? We just don't get explanation to why this has to be the mechanism, why it has to be done in this way at this point. Very little explanation. We think we can get all of the transparency on our side if it's necessary because of all the things that Gov said. We want it. What we don't want is for you to have to sell off your shares and give off a significant amount of control. We get zero explanation of why that's necessary. At this point, we're in a good job winning the debate. But let's talk about this legitimacy, because Netha gives you a lot of analysis here in terms of the extent to which this is a part of people's identity, the extent of what they put into it, and why they have the right to continue to control it. Here are the responses that we got to that, right? One, they said, well, you still managed to get money out of it, so what's the difference, right? This completely ignores the entirety of Netha's analysis. That is not just about the fact that you can still get money out of your company and you're getting paid for these shares, but the fact that you have literally created this thing with your blood and your sweat, and you have wanted to put in that, and you wanted to put in, and you put in those hours, and you took a massive financial and personal risk on this. That is like that is your baby in the sense of what you've poured into it and the extent to which you probably put your identity and your life's work into this thing. That is a very likely scenario when you've managed to grow a company from nothing to $1 billion company, what that takes from you. And we think that therefore you just have the right to continue to decide what happens with it, and what happens with this thing that you've created, what happens with this thing that we envision, just like any other form of art or anything like that, that doesn't respond. The second response that we get is to say, well, look, other people can just, they've probably sold off some of their shares to some other people anyway in order to continue to get some money. To which we say, okay, one, that's their choice. If that's what they wanted to do to grow the company, that's great, and they have the right to do it. You don't have the right to force them to do it. But second of all, that's actually why our case is one that stands, because obviously, by the time you're selling it publicly, when it's a $1 billion company, you don't own 100% of the shares, and you can't just sell 49% of them and retain a controlling share. You probably own, at this point, what is relatively controlling, relative to the rest of the people in the company. But when you have to sell a big chunk of them, likely together the shareholders and the investors that existed before are likely to now have a controlling share in the company, meaning that by definition, given that you've had to probably give off some of your control before and some of your shares before, you now have lost your controlling share when this mechanism comes into play. That is where everything that we're telling you comes into play. And why is this so important? We think that if we explain to you the extent of which this legitimacy is true, that means that the second house has to explain to us, one, why it is that they have any right to do this, even if it is like going to be positive for other people, why they have the right to take away something that is your blood and sweat to this extent and harm you to this much. Two, why other forms of regulation that are less harmful to you in terms of actually like taking away the basic control and basic ability to retain the thing that you have created and you have put your life into, why they're not enough. And thirdly, they need to explain to us, not just that this might harm people to some extent a little bit, but if, say, in order to accept things like taking taxes or anything else that they take from you, you have to explain that there is a deep necessity, and that we know with a big enough certainty this is actually the thing that we need to do in order for us to help the country or anything like that. These are the criteria that we set when we're taking away something that is to that extent of necessity to these people, and that extent to which it is their creation and has their right. And second house is going to have to do a lot in order to explain why they think that they have the right to do this. But sure, let's take closings for POI.
All of the workers in this $1 billion company are spending their time and are spending their money in order to be able to work for Amazon or whatever. Why do they not have then the right to also own that company? Why is it just Jeff Bezos who has any right towards the property of Amazon?
They're spending their time and they're getting compensated for the time. They're not spending their money to work in this company. But notice, importantly, the difference here is as follows. One, the extent of risk taken, both financially and personally, the extent to which is this fully your creation and your vision. Just because someone else worked to some extent on a piece of art, if you're the one who fully envisioned it and created it and like hired those people and etc., we think like this, that's the distinction that is made here. And we think that is why they have the right to control it. If they want to create their own thing, they have the right to do that, and they're more than welcome to. Okay, thirdly, let's look at whether or not this is actually helpful, because we explained, Netha gives you a ton of issues on why big companies are very, very likely to stagnate when they have their shareholder, when they go public, and why this is a very big problem for them. The response to all of this analysis is just the words, well, Amazon did it, so clearly it's possible. This is ignoring, one, the fact that Netha explained to you why at the point at which you're selling your shares, this is likely to be the kind of company that is a safe company in people's portfolio. That was not true at the point at which Amazon shares went public. And second of all, Netha just explains to you the likelihood. Yes, maybe Amazon did it, but many, many companies didn't. She explains to you why they are far, far more likely to be able to, in terms of their ability to carry through, in terms of the kinds of risk they're likely to take, in terms of who these founders are, etc., etc. None of that gets response. The words Amazon did it is just not enough. Why is this so critically important? We tell you that big companies are very, very often going to have to make massive changes. It's almost impossible to continue to exist in the world when you don't do this. This is because you have things like new competition that you didn't think come up. If you're a technological company, massive technological changes that that quickly swift changes that happen in culture and in society. All of these things mean that what you end up having is a very high likelihood that if companies don't massively innovate, you will have big companies crashing. And we think that is terrible for the economy. And that is why everything that Netha explains about why sometimes if they make the decision to keep it internal and they think that is the best way to follow through on the vision and the best way to innovate, we have to let them do that, or this is like to have disastrous accounts for our economy. For all those reasons, please oppose.
Great. I thank that speaker and call upon the member of government here.
Panel, some short reactions to the opening half, then I'm going to talk a lot about our own extension about democratization of power. Let's talk about opening half super quickly. Opening government brings a case that says there's a worse allocation of resources and that's not optimal for the market to perform. I have two questions about this that make me think that they're to some extent right, but this is not the most relevant thing in this debate. First of all, probably private financiers want a sound business model as well. As such, do, for example, the owners of that business or the people who created it. So why it's fundamentally different, I'm not completely sure. Second of all, I don't really know why I should care that much just about the efficient allocation of those resources or slightly better performance of those companies, making some rich people a little bit richer. I think that's something they don't explain, and that's why I think it's very difficult, although I think opening government is right in their logic, to credit them a lot within this debate. Opening opposition, I think, is mostly dependent on this idea of a certain property right. Namely, you've created something. They explain that that right to some extent exists. To some extent, we recognize that right. However, rights are always a matter of different competing rights over the same issue. Here's the big issue. Super big billion-dollar companies are incredibly powerful in society. And people are born into a state where they are coerced in their life by these companies constantly. They're coerced in the products that they have to buy in order to survive. The reality is that these billion companies have a lot of different power within a society, which means is that ultimately it's principally also unfair if at the moment these people are simply slaves of that bigger company. We all have to get Facebook whether we like it or not. If we all don't have any kind of way to control that company either. So yes, although we recognize property rights, they never explain why that's the most important right. We think this right of the general population not to be coerced is bigger because it affects a lot more different people within society, and it's probably a lot more important than sacrificing some of the still big benefits that you're going to get at the moment you own that business. Let's move on to my own extension. I think the framework of what private and public finance is incredibly important. Private finance exists because for small-scale companies, startups, etc., public finance doesn't work. It doesn't work for three reasons. First of all, nobody knows the company, so people don't buy the shares of a very small company that's still unaware of. Second of all, startups fail all the time, so you need individuals and investors that are willing to take on a lot of risk, which are these big private equity firms or venture capitalist funds with billions of dollars in endowments. And third of all, private investors play a very big role in the development of these startup businesses. There are venture capitalists with years of experience in startup development that now take a seat on the board and help guide these businesses towards getting bigger. That is the reason why private finance exists, but these benefits of private finance don't exist for big companies, for billion-dollar companies that have the know-how in-house, that have people knowing them, willing to supply them with capital, etc. So these benefits don't exist anymore. However, the reason that these businesses remain private is because the private investors in those businesses don't want to give up their stake, because they would be giving up their profits from owning 20% of Facebook, and they would give up their power that they get from owning 20% of Facebook that they get over the company in the direction that it takes. What we want to do is we want to correct this flaw. We want to transition power from these private investors to the general population. The first step in this argument is an explanation for why shareholders hold a lot of power over the management of a business. This is mostly for two reasons. First of all, the simple but very direct and very impactful mechanism of voting rights over impactful management decisions. Ultimately, at the moment a business wants to do a certain thing, they have to get that approved in a shareholder vote. That is, for example, who is on the board, what kind of investments are made, the general business strategy. And the shareholders always hold a vote of no confidence over the pure management within those companies. Hence, they have a direct voting effect over these big companies. The second way shareholders hold a lot of power over the management of a business is that they ultimately have their finger on the trigger. because shareholders can collectively sell a lot of stock, which tanks the value of a company, which in return makes other people sell their stock as well, which makes it difficult for the company to, for example, get to access new capital and make new investments, etc. So ultimately, shareholders hold the finger on the trigger to the head of sort of the company that exists. Given this, companies generally do what the shareholders want, or at the very least are highly influenced by the will of their shareholders. We think we should transition this power towards the interests of the public. That happens in two ways under our side of the house. First of all, the median shareholder becomes a much more average person in society compared to the opposition world. Note that under their side of the house, the ownership of businesses lies in the hands of, first of all, incredibly wealthy private equity funds that only care about their own return on investment. Right. So these private equity funds only care about their own return of investment, and in general, the endowment that you need in order to be able to invest in a company, in a private equity firm like that, is something like starting at 10 million or something above. These are very specialized funds directed at one thing, which is making these companies into their cash cows. Second of all, it's the multi-billionaire founders of these firms that opening opposition cares about. But given that these firms have been successful, these are also the super, super rich that are very distant from society. Under our side of the house, that is very different. You get average individuals buying stocks for their savings or their pension funds. Or their pensions. Note that pension funds are, for example, generally the biggest investors, but these are very often held accountable by the investments that they make by people that care about what's happening to their own pension. The same with banks. But it's a type of banks that are going to invest that directly interact with their customers that do care about, for example, climate neutral investment, not trading weapons, and buying stock that people like. You have a lot of banks that are actively, for example, advertising the type of stuff in which they invest, and people care a lot about that. You also get, for example, employees buying stock of their own business. So rather than the billion-dollar private equity funds that on opposition, under our side of the house, the median shareholder becomes a much more average person in society. That is mechanism one. Mechanism two is that the business becomes much more accountable to the media, because people in society want to find out what's going on in those businesses. People are doing research to them. They're writing stories about them. And the company cares more about the attention that they get and the stories in the business, because that directly affects their stock price. Whereas at the moment they're private, they don't give a shit at the moment they have a negative image in the media, because that doesn't affect anything in their wallets. Under our side of the house, companies are driven to operate much more in the direction of the public. That means more green investment, more employee rights, more things that people in general care about. We think that's incredibly important for these big words of businesses. Very proud to propose.
Great. I thank the member of government and call upon the member of opposition. Here.
I'm going to talk firstly why we don't think that the public, in being publicly traded, is actually going to influence those companies and why we would eventually get worse results. Then I'm going to explain why people would lose out. And the second point would be why the loss of control of the owners is going to happen to the extent where we're going to see conflicting interest and eventually the demise of those companies. And once again, people that are invested are going to be hurt much more. So let's start with the idea of public regulation, because we hear that from both governments. They really care about the public being involved and doing really good things. But notice, first of all, that the majority of the public understands nothing about stocks. They see those reports and they're empty pages of numbers. This means nothing to the average person. The only way for you to make this somewhat intelligible is if you have a reporter that is brave enough to go against someone that is that big and try to add up different pieces, or maybe find a whistleblower, which is something that it happens so rarely, to the extent where the public isn't going to really criticize those companies any more than they do today, especially since today we already have information, because the same incentives that we get for governments as to why those owners don't want their company to go bankrupt and why they want to have the trust of the public still exists. So we don't think that there's a major interest here that is going to be changed. But secondly, notice that buying stocks is not a democracy. The people that usually buy stocks are just another type of an elite and not the public at large. We think that especially for a company that is valued so much, the people that are going to have the ability to buy and to buy significant shares are going to be the economical elites, meaning that we are going to see much more private equity buying more and then having all the bad stuff that we get from CG, then more stockbrokers and people that don't really understand about how to run a company but just want to be a part of it. We're going to have speculants who just want the company to go bankrupt because they think that there might be something fishy because they have the logic of opening government coming here. And we think that there are also going to be other investors that want the interests of the competing companies. Now notice here that they say, but we can have regulation. But it's not that easy to regulate every person that buys stocks, considering that they can have other cash companies from other places. They can have friendships that then mean that you eventually get a lot of people with a lot of money that don't have really pure interest going at heart, and you don't really have the ability to say for each stockholder, this guy is problematic, that guy is problematic, and so on. So already on that, we think that there is a major problem. But also notice that those are the kind of people exactly that often don't want to change practices that are really bad for those firms. If we have someone buying shares of a very large company, usually what they want is they simply want to have more gains. Now, the way to do that in today's economy, unfortunately, happens to be often the repression of labor. That is why Amazon, although being publicly traded, treats its employers like shit, because everyone wants this to continue happening, because that's the way they continue on making profit. So we think that those kind of things are not going to change. But worse than that, we think that if those companies are indeed that bad and have such bad practices as we get from opening government, if it is going to blow out eventually through the very hard work of journalists and whistleblowers and so on, this is going to happen, that kind of reveal, at the point where you already have the people's pensions money on them, on already more and more people invested in them. And then when you have the reveal of the information, what are you going to have? You're going to have a collapse of the stock. But then you don't just affect the Walmart family, you affect everyone that has those stocks, meaning that eventually you simply take more people along with you on this horrible ride of losing out everything. So we don't think here that we get a good result. And lastly, if you have people falling for WeWork, people like SoftBank, notice that this is going to happen even when there are public stocks, because you can still have a charismatic leader and you still have people that can fall into thinking that maybe office space is going to be the next best thing. And because they see that the stock is going up, because more and more people are buying it. So no change once again on their description of the problem. But then let's talk about the idea of why we're going to have a loss of control. So notice here that opening opposition asserts that, and then closing government actually does the analysis of why we're going to get more loss of the control of the owners themselves, because they talk to us about the idea of the voting and no confidence, and we think that many times there's going to be divide and conquer among the family and so on. But why do we think that this is going to end up in a very bad result? So first of all, we think that this is often going to lead to hostile takeovers by people who don't have the company's interest at heart. Or we are going to see a situation where even if you don't have those problems of interest that I've talked about, there is still a problem with market interest dominating and being above all else. And what do we mean by that? So we have two types of companies: governmental companies and non-governmental companies. So for non-governmental companies, notice that a lot of them rely on the fact that they can be independent from what the market wants. So for example, if you have military companies, if you have credit consultancy groups, even if you have Facebook, notice that often the market is the kind of thing that would make them go off course. Many business owners don't want Facebook not to endorse them, don't want Facebook not to do things that might go against them and against those elites, unlike Mark Zuckerberg that might want to appease certain users that are not necessarily of that elite. When we talk about the interest of government, it tells you not to sell weapons to certain individuals. And yet, we think that the market often does want you to sell to China because this means more short-term profit, and they don't really care about the fact that China is a bad actor. Also, we say that when it comes to rating agencies, this is once again more of the elite making sure that no one is being covered, that no one is being discovered for the bad things that they're doing, and they would want to influence as much through light censorship, through those board meetings, what the company can do. But also also when we talk about governmental companies, which also fall under the mechanism of opening government. Notice that in their world, we have government monopolies that are now going to be under the market. This is going to cause more cases like Flint, in which you have more and more companies that don't want to give to the public, that only want to raise prices because now they are a monopoly that can do really bad things, unlike government, which has to be somewhat accountable, or people who have to look after their legacy. For all of those reasons, we're very proud to oppose.
Great. I thank the member of opposition and call upon the government whip here.
So as with all econ motions, a lot of things are said, and that's good, and that's awesome. I'll try to make the most out of summing this up for you and showing which the important clashes are. So what I'll do first is respond to the whole closing government case. I think that they think that companies are now going to do what the shareholders want, but they never prove that the same shareholders are not going to be the institutional funds, the mutual funds, and other big companies that will buy these companies, because they are the only ones who have the funds to buy companies on such a large scale. Right? So it's not going to be individual small buys and all that. And that means that there's no direct control from people, because people don't have time or knowledge to direct and manage multi-billion-dollar companies, which means that the maximization of value, which the people who are going to be running these companies, which are stockbrokers and all that, like mutual funds, managers and all of this, has twofold harms. And first is that workers get laid off, production gets overseas, and costs are cut compared to the private owner, because that's in interest of increasing your margin and all of that, which is going to directly harm the people who actually created the company, which are the workers which governments want to defend. But secondly, there are huge incentives not to run the company well, but they increase the value. And thus cause very volatile things in terms of the stock value. Pension funds are going to get crippled because of this, but also they fuck over these companies in the long term, because the only thing they want is to increase value. Comparatively, the private private owner does not want that, because it doesn't have a lot to do with the value, because it doesn't get the money from the value. And I think the problem with this, even if you don't buy this, is that the same problem is more present with corporations already. Mark and Jeff own billions of dollars, no matter that the company is traded publicly. No one can make them sell their shares if they want to, which means that the comparative is either they fiat the majority part of the company for the stock trade, which they don't according to OG's model, or the problem is solved marginally on the private-owned companies right now, but it's still huge on the other side where companies are already traded, which I think that at the end is unfair if you want to solve the problem of people owning a lot of things and all this. But secondly, there is more public interest in having the public own the company than it be traded on the market. All utilities, all public healthcare companies and all of the other things need to be traded on the stock market now. Recognize that the motion does not say privately owned, but it just says a company that's over $1 billion, which means that the comparative is if you have a government-owned company in the status quo, which can cater to the citizens of the country, with the comparative that you have to trade it to the stock market, and then the analysis from closing government says that stockbrokers and all of these other people who are going to run the company are going to be better in managing it for the interest of the people than the government-run company. I know government-run companies have problems with inefficiencies, but I don't think this is simply true. Okay, let's go on to framing and first half of this debate. Frame. There are hundreds, if not thousands, companies like this in the world. Reasons why they are still private differ. Like some are public companies owned by the government, some are very secretive companies like the military, or companies that are rating agencies, or simply there are a lot of competition in the market, and if you disclose too much of the information, that means that you're going to get screwed up. What does this mean? This is important because we go further than opening opposition when we explain the following thing to you. And this is that people recognize that there are some benefits if you go public, but they can go public when they want, on their terms, on our side of the house. And people oftentimes do that. What they do on their side of the house is they say, you need to go public now, you need to go public, I don't know, in the next 2 or 3 years, whatever the model is going to be, or plausibly what the model can be, meaning that you are forced to sell the company at the point where it does not suit you. And more importantly, if there are multiple companies, let's say Lidl and Aldi and Walmart, they are all like retail companies. They all get sold at the same time, means that you actually decrease the value or you wipe out wealth. This is more than opening opposition, because we say that the value for the private owners that might sell the company later on or go public decreases because you force them to sell the company at the same time and all that. But more on opening government and the information thing. I think it's already in the interest of big companies to be as transparent as possible. This is because of customers, because of public perception, because of banks. Because if you don't have stocks, the only way for you to get capital is that you get bonds. And bonds are very, very tightly monitored and closed market, where all of your business performances, key indicators and all that are analyzed, because banks do not want to lose money. This means that there's an incentive for you to actually be transparent as possible. But also recognize that everything that governments are talking about is true. Yes, governments, if they're only owned by one, companies which are owned by one person or a family of persons, are perceived as dictatorial by the market. That means there is every incentive for them to not be perceived as such, and there's no need for the government to actually regulate that they do not need perceived for much, because the market already does it work, right? And the benefit that they had in this debate, and that's that WeWork failed and all that, I think SoftBank is a huge institutional investor. The scrutiny that they gave in that would be the same scrutiny that the market would give on these companies that would be like now publicly traded, which means that there's no comparative for them. Two additional impacts that we exclusively give you from closing opposition. First, independence. For rating companies, for military companies, and other financial institutions, that independence is crucial because they can only do their job if they're independent from the market winds and all the people who can, I don't know, try to take over them or actually invest in them. This is true for all of the like big four. We're doing like when you check accounting, I don't know the word, like revision and all of that. When they check accounting for big companies, they need to be independent from the market in order to give the exact reason or like to give the most credible thing. The same is for military companies. You don't want your military companies to be owned by a Chinese company or whatever. The second point is that investments, because the tax rate is lower on dividends than on extracting profits. That means that there's more incentive for the private guy to actually keep reinvesting in the company versus people who just want to make dividends because of the very reasons that they want to increase pension stocks or the wealth of their mutual funds and all this. These are two exclusive benefits that you get from our side of the house. And before I continue with the last point, I'm going to take a POI from opening. Closing?
Yeah, so we already told you that indeed you're going to get institutional investors owning a significant part under both sides of the house. The difference is the accountability of those institutional investors. Pension funds and banks that invest deposits are way more accountable to their customers than private equity funds.
I think that's not true. I think your usual private equity investor knows more about economics than your average Joe who invests in the mutual funds. I think this is why private funds are more accountable to their customers than the mutual funds. But let's compare the last thing, and that's the principle of private property versus principle of public interest. All the teams miss the comparative. The comparative here is that you have to balance these two things. And why this tilts over the balance? Because you have other factors and other people and other corporations in the market itself. And in the current situation where the corporate world is skewed toward corporations so much because of tax breaks, huge market inefficiencies, look at Facebook, look at Apple and all of these monopolies and all of this, because of capital accumulation and Apple buy back its shares and all of this, because of special rights privileges for the stock market, that makes it comparatively unfair to infringe on the privately owned companies compared to what you get with the corporate-owned companies and companies that are publicly listed. That's the comparative that the opening opposition is missing in this debate, because they solely defend the right to have your property, blah, blah, blah. And then closing argument can say, oh, but we tax things and all this. We give you a comparative of in how big companies operate. This would skew the right of property and like the infringement very much towards companies that are privately owned. And that's why at the other debate, this is a more nuanced analysis of how the principle should play out. Very proud to oppose.
Great. I thank all speakers for the debate and invite all speakers to virtually shake hands and then leave the Zoom room. Fantastic. Okay. Hi, guys. I am super sorry that we took so long. It was an excellent debate. We had a very good time discussing the round. Please come and talk to both of us afterwards, because we did not actually manage to come to a consensus, and we were unfortunately called to a vote right when we were trying to discuss the last split that we were not on consensus on. So the decision that eventually happened is that this was a back half debate, with the first going to closing opposition, the second to closing government, the third to opening opposition, and unfortunately the fourth to opening government. Okay, so okay, just a couple of thoughts before general comments before I start off the feedback as a whole. The first is that I think this debate would really have benefited a lot more in terms of characterization about what the process of going public actually looks like. Because I think here and there was scattered characterizations of what exactly it means to be a publicly listed company versus a privately listed company. Not that much in terms of what the process of transitioning from private to public, or what the process of listing a company on the public market is looking like, or what kinds of effects or implications it might have for companies. The second is that I think this entire debate could also have benefited a bit more from a discussion of why specifically we are only talking about really large companies that are valued over $1 billion, because I do think at some point this discussion drifted into, is it better for companies to just remain private, or is it better for companies to go public? To which a lot of the answers that came out were primarily like, it depends. Okay, so just starting from opening government and working my way up from there. Okay, so from opening government, we got, I think, three main arguments. The first is that in private businesses, you are not necessarily obligated to share information about assets, funds, and revenues. You're not necessarily overseen by governmental bodies. Regulations exist, but there are no legal implications if you are caught out, and there is very little public incentive to hold you accountable, even if you are caught out. Okay, a couple of things about this argument. The first is that I think opening opposition does call you out about existing methods of regulation and scrutiny that exist in society. So they talk about how there are actually very few companies that are this massive. Companies this large are usually audited quite regularly. Companies like this are normally funded through banks and venture capital who want to ensure they have some kind of return on investment. So they do scrutinize the financial records of this company. And they question you about why exactly we need to go public in order to get all of this information about assets, funds, and revenues. And I don't think there's a full response to it. So it seems like from the start that opening opposition has presented a less restrictive way of getting to the many of the benefits that you want. The second thing to note about this is that a lot of the arguments you give about the lack of regulations and the lack of transparency is actually quite vague. So when you talk about how there is no public incentive to hold them accountable, you essentially say once they go public, shareholders can hold them accountable. But you also don't really discuss this in much detail. And I think closing government is the team that is able to fill in the gap here and able to explain the methods through which shareholders can hold companies accountable, as well as the reasons why media is more likely to pick up on company scrutiny. Okay, the second thing brought up by opening government is this idea that the way a company works can often be shady in status quo. It's not sustainable, and they often ride by on having very charismatic CEOs, but actually a business plan that is full of holes. And forcing them to go public is going to expose these flaws, which will cause them to either adapt or die. Okay, a couple of things about this argument. The first is that I don't think you really give a good or clear explanation of what the adapt or die model of business really looks like. I'm not entirely certain how the process of forcing a company to go public is going to make them really re-scrutinize their own business practices, although I can definitely see where it's going. And I'm also not entirely certain about the implications of a company going public and immediately just like collapsing. And I think opening opposition does call you out on this, and closing opposition does to a much larger extent, where they actually explain that if a large company crashes and you have a lot of public investment in this, this is actually really bad because it causes all these individuals to lose their investment. So now you're no longer squandering VC money, you're squandering public shareholder money. The third thing given out by opening government is this argument about the impacts of the impacts of private companies doing shady things. So just explaining why there is a worse resource allocation by governments, and it gives public competitors a kind a barrier to overcome, in a sense, because they are now competing with private people who have very charismatic shareholders. And I think, as closing opposition points out, the very charismatic shareholders on public companies do still exist, and public shareholders are likely to be very taken in by them. The second is that closing opposition points out that you are going to be flooding the market with multiple companies at once, which is probably going to be even worse for existing companies on the market. Okay, so doing that, understanding then these arguments and doing a direct comparison to opening opposition, I think there is not enough response in the opening government case about, first of all, why we are going for this extremely restrictive policy when there are existing regulations regarding transparency of information. And second of all, as well, is because opening opposition started talking about ownership and property rights and claiming that this policy is illegitimate. So the way they framed this argument was by explaining that company owners tend to put a lot of effort into their work. They put a lot of their identity into their work, and they don't often get paid back for all the work that they necessarily do. So the response I get from opening government is this idea that they are able to cash out very easily, so they still get compensated in some way, and that they are also able to get funding from VC, so they have already given up some level of control. But I don't think this deals fully with the opening opposition argument, because opening opposition also claims that this is about giving them the choice to do so rather than forcing them to do so. So if you're trying to make an argument that they should be forced to act in this manner, it cannot be enough to just say some of them have already made this choice, but rather that this is the choice that we have the ability to force all kinds of other private companies to make as well. Okay, the other thing about opening opposition is that I think opening opposition gives some reasons to believe that private companies have a level of flexibility that public companies don't necessarily have, and I don't think there was a sufficient response to that either. So given all of that material, unfortunately, you don't manage to place over the other teams within Sprem. Okay, so looking through what opening opposition brings. Opening opposition, transparency of information, property rights. The third argument about how companies do better under original owners, talking about how shareholders buy into large companies because they are reliable and therefore are going to be risk averse because shareholders want dividends and profits, and an argument about how big companies must continue to innovate in order to continue existing in the world and deal with things like technological disruptions. Okay. So I think I've explained already how this weighs out against what opening government says. I'm going to do the direct comparison with closing government here. And I just want to flag that the opening opposition closing government comparison was actually a discussion that we were having that we did not manage to come to a consensus on. So this is merely going to be my opinion of how opening opposition and closing government played out. Please also, talk to us more afterwards to find out more about it. Okay, so opening opposition's claim about ownership and property rights essentially rests on two strands. The first is that whenever you put in a lot of work and effort into something, that thing belongs to you, and therefore you should have control over how you then choose to dispose of it. So we can't take it away from you. We can't force you to display it in a museum or go public or whatever. The analogy here is a piece of art. And the second strand of this is essentially saying that this is actually a huge loss of control, not just a minor loss of control, because you have already given up some level of your company to VC as well as to private other sources of private funding. Therefore, it's not as though you are going from 100% of property ownership to a lower percent of property ownership, but rather that you might end up in a minority. So it's an extremely huge loss of control, not just a minor one if you are forced to go public in this manner. What does closing government say in terms of property rights? A couple of things. I think first of all, they say that it's not just the owner that invests time and creativity and sacrifices, where yes, the owner may have invested most of this time and creativity and sacrifices. A lot of the work also could not have been done without the workers. So presumably there is also some level of rights on the part of the workers. I think the response given to this on opening opposition is that workers are compensated for, which I think is fair, and closing government doesn't really pursue this line of argumentation enough to deal with the idea they can compensate workers. The second argument closing government raises in response to this is that governments create circumstances for the company and therefore should also have some kind of right in response to the company. So again, not a fully developed strand, but a line of argumentation to believe that property ownership of the company is perhaps not only with the owner. Okay, so I don't think it takes down the argument. I think it maybe throws some doubt on the argument. The second thing closing government does is to actually make a separate principle argument that is not reliant on the idea of property ownership. And this is an argument about democratic accountability, which I think they take to a much deeper extent than the argument that opening government gives. So they essentially argue that billion-dollar companies are incredibly powerful. People are born into a state where they are coerced constantly by companies because they must buy products to survive, because they must work for companies, and also because these companies have tremendous influence in society. And then they say it is therefore unfair that people are slaves of a bigger company if they do not have a way to control the company. So because a company has outsized impacts on people, not just the people that work for them, as well as society as a whole, there is perhaps some reason to believe that it can outweigh this idea of property rights. Okay, so in our discussion, I personally found this argument to be somewhat persuasive. I thought that it showed that the property rights discussed by opening opposition were not necessarily absolute, and that there were other societal interests that we should be considering when we are discussing how we are actually disposing of these companies. And I think that they are able to show to a sufficient extent that this is specifically about billion-dollar companies and about eroding the rights of people and to the ownership of their companies only when their companies grew large enough to infringe on the rights of other individuals within society as well. And I think that sort of also responds to opening opposition's attack to opening government about whether or not this should, like what exactly the difference is between a $1 billion company as well as a smaller subset, private companies that are smaller in value. Okay, so the second point of clash, not other than the principal one, which I personally was of the opinion that closing government very narrowly took over opening opposition, is the idea of what actually is going to happen once a company goes public. So opening opposition's claim is that shareholders are risk averse and big companies want to make lots of changes, whereas closing government actually flips this argument, and they actually argue it's very likely that even in private, large companies are slow because they are so large and so very bureaucratic, and that it is actually better for them to be slow because if they take unnecessary risks, there are going to be huge implications on the job market as well as regardless of whether they are public or private. So the externalities of failing, they claim, is less likely to happen. The second claim they have here is dealing with this idea of innovation in order to keep up with technological disruption brought by opening opposition. Closing government claims that they can actually deal with this by buying up small companies that innovate, and so it seems to mitigate quite a lot of the harms of stagnation and low risk that opening opposition is talking about. The third thing that closing government is able to bring is just more detailed analysis of why accountability and scrutiny works to a much greater level than just the regulations brought by opening opposition. So where OG and O had a tussle over whether regulation alone could solve it, I think closing government explains the processes of shareholders having power over management, voting over impactful decisions, collective selling and tanking the value of company, etc. So all of that explaining why there is more scrutiny on the part of closing government as opposed to opening government, which also responds to opening opposition's counterclaims about how regulation is sufficient. Last of all, and I think this is less proven, closing government gives some reasons why people are going to be more likely to be part of the conversation, even if it's not perfect, like even if you don't get perfect representation of labor rights or whatever, you do at least have some ability to push companies in a certain direction, which does lead to better outcomes. Okay, so I think they're able to flip a lot of the arguments about why it's worse for companies, and they're also able to explain why it's better for workers, perhaps. Okay, so now doing the comparison between closing gov and closing opposition. Okay, so I think closing opposition does a couple of interesting things. The first is that they directly push back against the idea of democratic accountability brought by closing government. And the way they do this is to explain that when a company is valued so highly, the people who buy in are usually economic elites, and they're not going to be buying in individually or only through pension funds. It's probably going to be like just swathes of middle-class economic elite buying in through mutual funds or stockbrokers. The second thing they point out is that the majority of the public actually understands nothing about stocks, and therefore it is still going to be mutual fund companies as well as large corporations doing the scrutiny as opposed to any additional kind of individual scrutiny. So I think closing gov does, so I think this does mitigate to a certain extent closing gov's democratic accountability argument in terms of how much shareholders are actually going to be able to tug companies more liberally and more like labor words. The second thing closing opposition claims is that this just leads to worse practices from companies because shareholders are often the type of people that don't want to change shady practices. So they give two harms that come from this. The first is that they try to increase profit margins by sending production overseas, cutting costs, laying off labor, because that actually benefits shareholders, but it doesn't necessarily benefit the people who are working within the company itself. So that cuts directly against closing government's claim that democratic accountability helps labor because labor are the people that are able to buy into the company. So while I am still persuaded there is more democratic accountability on closing gov, closing op shows that the extent of this democratic accountability is definitely not as large as closing gov would like to claim, and also that the way in which it functions may actually make things worse in terms of outcomes. The second thing they claim is that the incentive is not to run the company well, but to increase value, because the private owner doesn't actually get money from increasing value, but shareholders do. Okay, the third thing that closing opposition claims is they talk about the economic impacts, and they talk about what actually happens if companies are overvalued and they just burst on the public market. So I think this takes opening opposition's argument and runs it in more detail, because they walk through step by step what actually happens when you don't have the idea of accountability. And then they talk about how stocks can get they give the mechanism for how stocks for certain companies can get overvalued on the public market due to people just rushing to buy because they are seeing everybody else buying, as well as stocks evading scrutiny, and then explain what is likely going to happen when the stocks burst. And I think this actually also cuts against closing government's arguments about how this makes things a lot better for the individual shareholder on the ground that's investing in these, because they're interested in like climate change and climate sustainability funds or in their pension funds. Okay, so closing opposition manages to use closing government's principle and show it works out worse for all the people involved, even if nominally they get more rights. The outcomes they get from those more rights are not necessarily the outcomes that closing gov wants.